Good evening, everyone. Thank you for joining us tonight at our webinar. Tonight, our keynote speaker will be Dan Dick. He's the founder of Solomon Financial Corporation. Dan's been in the investment business since 1994. He has the advantage of being through the ups and downs that we have had through the market cycles. We're glad that you have tuned in to hear some of the great information that he's going to share with us. Some of the topics that Dan will be covering are current market conditions, winning behaviors in turbulent markets, winning strategies in these markets, practical options to guard your capital and regain lost ground, how to ideally separate corporation, business, and personal finances, managing cash flow, and using your business or corporation as your biggest tax shelter. I'd like to welcome Dan Dick. And you can have this.
Thank you, Tammy. Hey, welcome everybody. We're happy that you're able to join us tonight. We're going to be getting into a fair amount of detail tonight. So specifically, this event is for corporate owners. We also will be discussing a little bit on COVID-19, but more in a general sense, not really as it applies to your business, but some of the strategies that you can look at during this time as it applies to business. So let me hit a few ground rules before we go in. There's a couple of functions on the bottom of your screen. One function is your Q&A function. So if you have a question that you would like to ask and you don't mind it being a public question, go ahead and hit the Q&A and feed your question into there, and then our moderators will be answering those questions. If there are questions that our moderators don't have the answer to, which is entirely possible because we don't know everything, not every one of us knows everything, we will peg those questions, save them, and get back to you after the seminar. The second function that you have is your chat section or your chat function. If you hit chat and you type a question in there, it is a private question that will only go to the moderators, so nobody else will see it. So if you'd prefer that, you can do that as well. Either way, we'll endeavor to get your questions answered, and if we don't know them, we'll get back to you. Let me talk to you a little bit about don't know the answer. If you ask a question and one of the moderators types in, that is a great question, it probably means we don't know. At Solomon, first of all, we don't mind admitting when we don't know something because there is a lot to know. Secondly, we are specialists. What that means is that our whole model in terms of how we work together in teams is rather than working as a single advisor advising a client, we work in teams of advisors to advise that client. At the end of the day, we all work together very, very well, but we have different specialties. So there's certain things that some of us know really, really well, and certain things that other people know really, really well. And when we come together as a team, we can create some pretty cool stuff. But it just means that you might have a moderator on tonight. All the moderators on tonight are advisors, but they may not specialize specifically in the area of your question. So bear with us, and then we will get answers back, but some of those answers will be scouted out by going to other advisors that specialize in that particular area you've asked about. Okay, so we're going to launch in, get started. And as we do that, I also want to ask you for another thing, and that is, it is hard talking to a camera. It's way more fun to talk to a room full of people. But with COVID-19, that is suddenly no longer an option. And so this is very new to us. It's very new to me when I'm talking to a camera rather than a room full of people. So I'm going to ask you to do me a favor, and I'm going to ask you to smile and nod, even though your cameras are off, and just agree and be excited and laugh at my jokes and all that. Because if I think that's going on behind the scenes, I'm going to have a much easier time talking. So if you don't mind doing that for me, I'd appreciate that. I'm hoping that that's a deal. All right, let's jump in. First of all, we're going to talk a little bit about COVID-19 at the end of this session, but I want to just intro that just a little bit. So we're going to sandwich this whole thing with a little bit of, what's the bad news, and then later we'll talk about what's the opportunity that it creates. So COVID-19 is, I'm not wanting to make light of any of the health risk, and that's not at all what we're going to talk about, but we are going to talk about financial risk and how how COVID-19 is affecting our financial health, and how do we regain that financial health? How do we minimize the damage to our financial health? That kind of stuff. So the first thing to understand about COVID-19 is it is like the perfect catalyst in a perfect storm. What I mean by that is that we had markets that were doing very, very well leading up into this period of time. In fact, most would argue that the markets were probably close to getting to a point where they're overvalued. The difference is that we could have probably continued on that track for another year or so, but at some point we would have had a pullback because things were getting quite inflated. Now, here's the reality. A year from now, if we had had a pullback, it probably would have been a slow kind of downturn that was a little bit more moderated and so on. But COVID-19 came along just sort of at the right time and created a lot of panic selling in the market. So what does that mean? Well, first off, what it means is that a lot of this stuff is not real. Some of it's real, and in terms of it actually impacts the economy. So when something impacts the economy, what that means is that we are actually losing potential revenue in companies, in businesses. We're losing revenue, and that revenue may not come back again. I'll give you an example. If you were going to take a trip to Mexico and you take one every year, but this year you had to cancel your Mexico trip, you're probably not going to take 2 Mexico trips next year. Well, you might. I might. After all the stress of everything that's happening, maybe we'll take 3 next year. But the point is, most people will probably not take 2 next year. They'll take 1 next year. So that is lost revenue in the markets for the companies that would have been affected. So that's kind of the real impact of COVID. The false impact of COVID is the panic. It is it is people rushing out and filling grocery carts full of toilet paper. That kind of stuff is a false impact in the economy, or in the markets rather. So the difference is, one is an economic effect, the other one is a market effect. Generally speaking, the economy will be a little bit more steady, and the markets go up and down as they revolve around that more steady line. And right now, of course, we have an exaggerated downturn in the markets. We're going to talk about that at the end and kind of what we can do to take advantage of that. All right. Second thing we're going to talk about is cash flow planning as it pertains to your business. I'm a business owner. I've owned a corporation for probably close to 20 years now. And here's what I found about owning a corporation. Owning a corporation, the government of Canada, when they did some of these legislative changes around taxes at the end of 2017, had made some pretty offensive statements. And those offensive statements had to do with thinking that corporation or corporate owners somehow had a distinct advantage or an unfair advantage over their fellow Canadians from a tax perspective. 2 things about that. Number 1, we do have an advantage. Owning a corporation does give us an advantage. I would argue that most people that own a corporation do not take advantage of the advantage that we've been given. Secondly, it's not unfair. The amount of risk that corporate owners take, as is very, very clear right now in the economic environment that we're dealing with, the amount of extra risk we take is commensurate with the amount of reward that we might be able to receive. It's not offside, and it's certainly not unfair. Our economy is driven by small business. When we look at what small business does in terms of employment and driving the economy and keeping things rolling in our small communities and in our larger communities. Small business owners, in my opinion, need a pat on the back. And in times like this, small business owners rather, are the ones that are taking the biggest hit. When you see businesses that are closing their doors because of COVID-19, it's pretty rare that those big corporations are going to pay much of a price compared to that small business owner that's struggling to make payroll. I heard a story today about a company that had to close shop for a period of time, laid off their employees as a result. And because they laid off their employees as a result, they actually were unable to pay payroll, so payroll checks were actually bouncing. That's a scary position to be in, and I know that that's no fun for the employee, but I guarantee you it's a lot less fun for that employer who doesn't have the money to actually pay their payroll. So those types of situations going on right now highlight that as business owners, we take on risk that the average person in a job doesn't necessarily have to deal with. And so having some advantages from a tax perspective, in my opinion, is fair, not unfair. So I don't know if you can tell, but that was offensive to me that the government of Canada was talking about their business owners as if we're some kind of criminals for paying less taxes. So that's the first thing I want us to understand, is that the tax advantages we have by owning a corporation are real, but they're not unfair. And so we're going to talk about how to take advantage of some of those tonight. Let's deal with cash flow. What do I mean by cash flow? Well, Another thing I learned about being in business for myself is it became very difficult as revenues can go up and down in a corporation. It became very, very difficult to differentiate between my personal income and my business income. It became difficult to leave business income alone, particularly when business was doing well. And it became even more difficult to leave my personal resources alone when business was not doing well. And that bleeding between personal and business can certainly become a problem in your personal life and in your business life. We need to have clear distinction between the two. So I want to talk about that just a little bit, and how do we manage cash flow in order to create that distinction. This is from years and years of trial and error on my part, but also as advisors when we're working with families that own corporations, own small companies. We're always working on this as step number one, which is establishing a clear flow of cash from the corp to personal and everything in between to make sure we have good distinction between the two. So we're hoping that this is going to show up okay tonight. We've got some new markers, so we're hoping that it's going to be clear. So here's our corporation. Randy, give me the thumbs up if that's coming through clearly.
I'll maybe zoom in.
Okay. Okay, so there's our corporation. And this is kind of what it looks like. Money flows in, revenue flows in into your operating account. Okay, so you now have money coming into the operating account. If you're a small business owner, you know that sometimes there is no money flowing into your operating account. And sometimes, hopefully, you have good times where there's extra money flowing into your operating account. Here's what we need to do to have an effective start to this whole cash flow process. And that is, we need to have a good reserve inside of that operating account. So a good reserve is different for every business owner. We don't know exactly what your business looks like and how much money is realistic to have in reserve. But generally speaking, what we like to see is that if you have a couple of months of operating expenses put forward, that's a good place to start. We've sat down with lots of business owners where we sit and look at their reserve fund, and there's nothing in reserve fund. And so sometimes there's some creative solutions that we got to come up with to get them in a position where there is a reserve there. And honestly, the bigger the reserve, in a lot of cases, the bigger the reserve, the better. And so if you can be in a position where you're running your business and you're not always stressed about how am I going to pay myself and my mortgage payments and all that kind of stuff next month, you are much more clear-minded then to run your business and do what you need to do without it being this month-to-month battle. So we do some sort of fairly creative things sometimes to create this balance in here. And a lot of times, you guys, when we do that, we'll sit down with business owners and they say, well, we didn't know that was even a possibility. We didn't know that resource existed to create that reserve fund so that I can think more clearly. Think about it this way. If I'm living paycheck to paycheck as a corporation, and I don't even know if there's a dollar coming in next month, what happens to my stress level? What happens if my stress level is high? We always say that if emotion is high, intelligence goes down. What that means is that I'm not free to be creative and really drive my business if I'm constantly just thinking about where's the next dollar coming from. I generally don't make very good decisions about what's the best business move. So this is a vital, vital piece, is to get that generator of cash flow, first of all, solved. Next, we have to establish how much money we need to live. There has to be a clear amount, and it has to be predictable, and it has to be the same-ish every month. So whether that's salary or dividend, we're going to get to that in just a little bit. Whether that's salary or dividend, it has to be the same. Now, for business owners, if you're a business owner, you're listening to this going, well, wouldn't that be great? Some of you are like, yeah, I've got that settled years ago. Others that are newer to this kind of world are going, well, wouldn't that be great if I had a steady income coming out of my corporation? I refer back again to that cushion fund. If there's a cushion fund there, you can actually set it up in advance and know that, yes, I'm going to be okay. There's going to be enough money coming into my household to pay all my bills versus constantly stressing about whether or not there's going to be enough money next month. So this is vitally important so that we can do this. And once again, if you're thinking, well, how in the world do I do that? That requires some help and some planning and some usually some strategizing, new ideas, creative ideas, etc., to create this so that this is steady. For those of you that have are in a relationship, spouses, and one spouse owns a business, a lot of times that can be a real thorn in the relationship if that income isn't steady. So we need to make sure that we're creating this so that we can create this. Next, once that money comes in, it's going to go into two places. One is your bills, and the other is your spending. One of the things that I think early on for me that I struggled with, because it was kind of just always feast or famine kind of thing, I didn't even know what my spending or my bills were. I knew that if this was really strong, this was equally strong. If I had great revenue up here, I was doing some really Olympic type spending down here. If this was weak, so was this. And if this was really weak, so was this. This caused trouble in the home. So if I'm looking at this from the perspective of how do I get some normalcy in my life financially while I'm growing a business? Well, again, I go back to this, you got to have a good cushion so that you can pay yourself a certain amount of money. And this is where you live, not up here. We need to divorce our emotion from this. And the only way to do that is to have a clear number here. And the only way to keep a clear number here is by deciding in advance, what are my bills? And deciding in advance, what am I going to spend this month? If you have that number down and it just becomes routine, then as this number grows, what happens? This number grows. Instead of as this number grows, this number grows. So this is something that we talk to all of our clients about. It's something that I remind myself of constantly, and that is there is a clear line between my corporation and me. My corporation might have very strong revenue, but that doesn't mean that I can be a very strong spender. I get to decide in advance what I'm going to spend, and it makes no difference what comes in this month. It's based on predetermined amounts that my wife and I have sat down and decided that we're allowed to spend. So this is where you live. As a business owner, you need to learn how to live below this line. And this gets into a little bit of our tax planning that we're going to talk about momentarily. But up here is where you build a life. Above the line is where you build a life. Down here is where you live. So what do I mean by that? Well, a lot of business owners, and again, I'm going to argue this in just a moment, but a lot of business owners say, well, I want to take a trip, so I'm going to start pulling money out every month to save down here. You notice there's no savings down here. I'm not saying you should never save personally. What I'm saying is I never save personally. What I'm going to show you here is my own personal way of running a corporation. I never save personally. I pay bills and I spend. Everything else for me, I keep up here. And I'm going to argue that from a tax perspective momentarily. So for me, this is where I build my life from a couple perspectives. Number one, by building a successful business, but also number two, by building my savings, my short and long-term savings inside my corporation, where the tax environment is significantly more friendly than the tax environment is outside of the business. Okay, so that's how we work with cash flow. I just want to take a moment there and just kind of explain when we're doing a plan for families, when we sit down and we're doing what we call a GPS, which, by the way, that's what we title a plan, but it stands for goals, priorities and strategies. Excuse me, that's a new expression for us, but GPS, goals, priorities, and strategies. When we do that, we always start with a family on cash flow, whether they own a business or not. We work with them. We don't charge them anything, but we work with them to figure out, how does this flow look in your life? How does this flow look in your business? And we help them to set these numbers up. We help them to set this up. And then we help them to determine, should this be salary? Should it be dividend? Should it be a combination of, etc. So that's cash flow planning in a nutshell. And we have some great tools around that as well for people, even if they want to work through it themselves. If you just want some of those tools, let us know on the chat, and we'll make sure that we make a note of it, and make sure you're giving whoever, if you're asking for it, make sure you're giving our moderators your email address, and we'll make sure that we get you those tools, those cash flow planning tools. All right, moving on. The next thing that we needed to do for my wife and I, when we went through this process, the next thing we needed to do was to figure out, what are we paying for personally that we should be paying for corporately? What are we paying for personally that we should be paying for corporately? Now, why is that a thing? Well, let me explain. Down here, my total personal tax burden is about 30+%. Just so you know, anything that I'm making over $48,000 and change, down here I'm paying 30.5, and then it graduates from there. But so tonight, for our purposes, we're just going to use 30%. Some of this stuff is way more significantly exaggerated if you're in a 40+% tax bracket, but for tonight, let's just use 30%. So I'm paying 30% tax down here. Now, as a small business in Canada, this year I'm paying 10% tax. And to be clear, what I mean by that is not that I'm paying 10% tax on every dollar I earn. I'm talking about I'm paying 10% tax on the dollars that I earn that don't go towards other business expenses and aren't paid out to me. So the money that sits inside the corporation after I've paid all my expenses and paid myself and all that kind of stuff, net dollars, not quite an accurate term, but if we call that retained earnings, we pay 10% tax on those dollars, okay? 10% tax. Now, if I then take that money and decide to pull it out and save that money, that's when I'm going to no longer pay taxes here. If I'm paying a salary, if I pay that as a salary, I'm going to pay my salary tax on that, which we're going to call 30%, and I'll pay no tax on there. So there's a 20% tax difference between just leaving it in the corp and saving money versus pulling it out and saving money. 20%. So if I could guarantee you a 20% return every year, if I could guarantee you a 20% return every year, would you take it? And I hope the answer for you is yes, I would. And of course, there's other extenuating circumstances that we have to assess on an individual basis. But generally speaking, that's about the difference between leaving it in the corp and taking it out of the corp, about a 20% hit. So if you're saving outside of the corp and you want to save, if you put $1,000 here as an example, that $1,000 travels through the corp and comes to you, you have $700 to save. If you stop it in the corp, you have $900 to save. So mathematically, this one is going to be worth significantly more than this one. And yes, there's other considerations. For example, are we using RSPs or TFSAs or those types of things? But for now, we're going to just deal with the raw math, and we can talk more individually if you'd like to explore more options about should I be using RSPs or not, or TFSAs, et cetera. Okay, so that kind of led for my wife and I, we said, well, if we're saving right now, personally, what if we uploaded that to the corporation? So I'm going to title this Savings / Investing. Because for me in my world, savings is if I need the money right away or within the next month or 2 or 4 or 5 or something like that. And investing is more long-term. So those two pieces, we were saving money. We would take money out of the corporation, pay the taxes, and then what we had left over after we'd put into investments. And we got thinking about that when we opened our corporation. And went, well, why wouldn't we upload that to the corporation? The second thing that we were paying for personally was a few forms of insurance. So those forms were things like disability insurance, critical illness insurance, life insurance, those types of insurances we were paying personally. And then we realized, we could actually upload those to the corporation as well. And there were other things, but most of those other things, quite frankly, your accountant has probably already hit on. There's probably things like your, a portion of your house, if you got a home office, a portion of your utilities, your mileage on your vehicle, different things like that, those are the normal things that accountants normally are pretty good at. But sometimes the ones that get missed are the big ones, and that is savings and insurance. The third one that we decided to do, not everybody does, and I don't think it's right for everybody, but the third one that we decided to upload was we went to dividends rather than salary. So let me just say a few words, first of all, about the tax treatment of dividends versus the tax treatment of salary. This is somewhat oversimplified, But basically, it makes no difference from a tax perspective whether I'm drawing dividends or salary at my income level. Now, the reason for that is because the government of Canada has done a great job at trying to integrate those two tax rulings so that it doesn't matter what you do, dividends or salary, you're going to pay the same amount. Let me just walk you through that really quickly. If I pay, these are not exact numbers, but it'll make the point. If I pay myself a dividend, I do not get a tax deduction in the corporation. So if I paid 10% taxes, I'd have $900 left over to pay. Then I would pay out my dividend to myself. And when I pay out my dividend, I'd pay a little bit more tax again personally, but not at 30%, more like at 20%. So together between me and my corporation, we paid about 30% in tax. Okay. Now, if I paid myself a salary, my corp now pays no taxes. All the taxes downloaded to me, and when I pay my tax, I'm going to pay more, like 30%. So at the end of the day, if I'm paying it all, or if my corp and I are splitting that cost, it's about the same cost. Now, the reason that we opted to go with dividends was for one major reason, and that was if we were paying ourselves salary, we actually had to contribute to CPP for ourselves, which is 2 of us as shareholders, and we had to contribute for the corporation on behalf of ourselves. So at the end of the day for us, that meant that we had to, if we paid ourselves salary, and by the way, that limit, that top end is $58,000 per year. So if we were paying ourselves $58,000 per year in salary, that meant that we had to send the government to the CPP program for our own portions and for our corporate portions each. We had to send the government just shy of $12,000 per year for CPP. Now, I don't know about you, and I'm not a conspiracy theorist. I honestly believe that CPP is a solid program. I think it's going to be there when you retire. That's not what I'm questioning. What I am questioning is the management of it. What I'm questioning is how much is going to be there when I retire in terms of actual return on my dollars in. Those are my dollars in. It's not a government program. That's my money going in. And so if I'm going to put $12,000 a year towards something, I'm going to spend the time to actually look at, is it a valuable investment? What I challenge you to do is look at what would $12,000 per year do for you if you were going to put that away somewhere instead of sending it to the government. If I pay myself dividends, I have the option, I don't have to, but I have the option of opting out of paying into CPP. There's other downsides to going with dividends. One downside is I don't accumulate RSP room. I'm okay with that because for me, I think that the tax shelter inside my corp is more effective than pulling it out and putting it into an RSP. Because when I put it into RSP, I know that I'm going to pay an awful lot of tax when I retire and a heck of a lot of tax if I pass away. So that part I'm okay with. I like the idea that the money inside my corporation, if I pass away, I can actually leave that tax free. We'll get to that in a moment. So there's some trade-offs there, but for my wife, Krista, and I, we opted to do dividends rather than salary. To us, that was a better deal. So now, all in, what that did for us was it was actually a pretty big number when we added up what we were saving, what we were doing in long-term investment, what we were paying for life insurance, critical illness, disability insurance, and what we were sending to the government, which alone was $12,000 per year. And we uploaded all of that to the corporation. That was a significant savings instead of paying 30% tax on 20. Now, without getting into a whole bunch of detail, the dividend part, excuse me, the CPP part didn't make a difference on taxes because that CPP contribution is separated before the tax issue. But the savings and insurance, all those pieces together, I'm going to use a generic number. Let's say that that generic number is $1,000 per month that I was putting towards all forms of savings, investments, and insurance. If I brought it all the way through, I would have $700 to deal with. Instead, now I have $900 to deal with to do all that stuff. That's a 20% gain immediately on my money. So I've got more money to work with. Then I added to that the $1,000 per month that was going to CPP. Now I have $1,900 per month to do something with. This brings up the next problem. The next problem is, what do I do with it? There's something in corporations called passive earnings. And so now, if I never accumulate extra money in my corporation, I don't care about this rule. But when I do this, when I actually upload this extra money into my corporation, the point of uploading it was to save it somewhere. I have a rule, and that rule is money saved isn't money saved unless you save the money. If you're not putting it somewhere, then it just gets blown in other things. We will figure out a way to disappear money. Most business owners are typically entrepreneurial, and we can't resist great opportunities and all kinds of fun stuff we can do. Here's the deal. I'm not arguing with you that your corporation can probably outperform percentage-wise, return-wise, et cetera, can probably outperform the return of a typical investment. It's not my argument. My argument is that the typical investment is your anchor. It's what makes sure that when I go home to Krista at the end of the week, what she wants to know is not what my dream is for my corporation. She wants to know, are we going to be okay at age 60, age 65, whatever the number is? She wants to know that the stuff we're putting in here, that anchor, is going to be there no matter what happens with our corporation. So we have a responsibility to ourselves, our spouse, to our families, to make sure that we're saving money that we save, not just turning that over into other projects and so on. So when we did this, we all of a sudden had a problem. Before that, we didn't, because our operating account was earning what % rate of return? The money sitting in an operating account might make 0.1% if we're lucky. But passive income, here's how it works. If I make passive income inside of a corporation, I'm taxed at 50+%. Depending on the province that you're in tonight, it can be quite a bit higher than that, but in Alberta, I believe we're sitting at 50.16 this year. I know BC is 50.67, but anywhere over 50% in any case. So what is considered passive income? Passive income is if we have an investment inside of our corporation that is either earning interest, dividends, capital gains, or rent. Those are the primary four: interest, dividends, capital gains, or rent. Any of those are taxed or earned inside of a corporation, we're going to pay 50+%. What's the logic behind that? Well, the logic behind it is that the government says, we didn't give you this sweet 10% tax rate deal for you to be able to hold investments inside your corp. We gave it to you so that you would actually stimulate the economy by going out and growing your business. Fair enough, I get that. So we want to be careful about this, and I'll give you a real life example, generic example of what this might look like before the tax rules changed. So there's another impact of this though, and that is this. Once I earn more than $50,000 in passive income, every extra dollar I earn takes $5 off of my small business exemption line. The small business exemption line basically states that we can make up to $500,000 in net revenue and only pay 10%. So what we've seen already happening is you have say you have a company that has a business, has a warehouse, etc., and they're working in that warehouse. That's part of their business, but they decide to upgrade and go to a bigger warehouse. They go to the bigger warehouse and they rent out their old one. As soon as they rent out their old one, that is passive income coming into the corporation, and that passive income could be $5 or $10 or $20,000 a month for those types of buildings. So immediately they're paying 50+% on that income. Plus, not only are they paying 50% on the income, plus everything they earn over $50,000 for the year, $1 knocks $5 off their earning potential, $5 off their earning potential under that small business cap. So we got to be real careful about that. We want to minimize this. So if I'm uploading this money to my corporation and I'm just investing it in a GIC or something like that, I'm going to lose half the return on that money, and that's not acceptable. So I need to look for other ways to shelter that money inside of my corporation without paying taxes. There's a couple of different ways we can do that. And it kind of plays nicely with some of these other things that we upload to the corporation, which in this case was life insurance, disability insurance, and critical illness insurance. So we want to avoid passive income tax, obviously. So how might we do that? Here's how I did it. What I did is I opened up an insurance policy inside my corporation. To be clear, the corporation owns the policy. The corporation is the payer for the policy. The corporation is the beneficiary of the policy, and I'm the life insured. So I'll explain what that actually looks like. Let's say that I needed $1 million of life insurance. Now remember that I was already paying, in my life, I was already paying for insurance down here, personally. The cost down here, and these are not exactly accurate numbers to my life, I'm using some generic numbers, but let's say that the cost down here was $200 per month for that life insurance. Well, to get that $200 per month, I had to make about $300 up here. By the time it came through into my hands, that's what I was left to pay for that cost of insurance. Up here, if I make $300 and then pay for my life insurance, what am I actually netting? Well, there's one extra calculation we have to look at, and that is called premium tax. When we pay for life insurance or any kind of insurance, there is a premium tax. I was paying it down here, but I want to make sure that we're dealing with all the math up here. So what that looks like is I would put earn $300. I would take 10% off for tax, so that's minus 30. And then I'd take another $9 off for premium tax. So what am I actually left with? I'm left with $261. That's my net dollars. Instead of down here, I had 200. Now, down here, I had to pay the premium tax too. So I'd have to take $3 off of this, or 3% off of this, to make it actually fair, but let's just keep it simple. So $261 now. So that $261 can pay for my life insurance. First of all, if I'm paying $261 instead of down here, I would have had $194. I can buy a lot more life insurance for the same money, or I can have extra money for savings and long-term investing. Either way works. In my life, I was able to turn that into more life insurance. All right. So I was paying for life insurance anyway. I just found out I could get it cheaper inside my corporation because of the tax differential. So then what I was able to do was, because this is what's called a universal life policy, I was able to take more of the money that I uploaded from down here and then shelter it inside that universal life policy and invest it. The investment inside is two things that are important there. One, it's tax exempt. I'll explain what that means in a bit more detail. Number two, it's an investment of my choice. I can pick, within reason, I can pick what I actually want that investment to look like, how much I want to put in, and there's a lot of flexibility to that. So there are other types of insurance that work well in these scenarios. Another one that works quite well is what's called a participating whole life policy. I'm going to be talking tonight about universal life. The reason for that is because this is personal to me. This is my story, and this is the type of insurance that I own is universal life. So I have a much better handle on that one. I'm going to explain that one in more detail. So money goes in, it's tax exempt. What does tax exempt mean? It means that it grows without any taxation on the gains. So I avoid out here what would have been passive income tax. This is not considered passive income inside my corp, and therefore does not attract passive income tax. And because it's under insurance law, it grows tax exempt. The second thing it means is that if I pass away while that insurance policy is in place, not only does the $1 million of insurance pay out to my family or whoever's the beneficiary of my shares, but on top of that, all of the money that I've been able to put in there over the years, all of these dollars also go tax-free, and I'm going to explain exactly what tax-free means, but tax-free to the people that I've named as the beneficiary of my shares on that corporation. So I can pass all of this insurance, plus I can pass all of the investment inside without paying any taxes on death. The last thing is, what if I live, which is what I'm kind of rooting for, to be honest. But what if I live? I've got all this money tied up in there, so we're going to spend a little more time talking about how I might be able to pull that money out. But we're not going to make any promises in terms of pulling it out tax-free. But there is a potential to get tax-free income from it during retirement. So I'll walk you through that. But I do want to make the proviso that we don't know what the government's going to do. We never know when things are going to change. So I'm going to show you also the worst case scenario, how you can pull money out but pay a little bit of taxes. All right. So this idea of having insurance inside of my company, first of all, allow me to buy more insurance for the same money. Secondly, it gave me a place to shelter money that was retained earnings inside my company and park them here. Now I want to talk a little bit about sort of some more of the details of that policy and what it might look like if you exercise this kind of an idea in your business. So I'm going to just zoom in on that one circle. And we're just going to look at just the policy now. So this is just the policy. Here's our insurance wrapper. And we're using, for now, we're using $1 million of insurance. There's 3 lines that are really critically important that you pay attention to when you're purchasing this type of a tax shelter inside your corporation. There's 3 lines you got to pay attention to. The first one is, what is this going to cost me? Okay. There's 2 different ways to actually calculate the cost, or I shouldn't say calculate the cost. There's 2 different ways to purchase that insurance from a cost perspective. The first way is you can buy what's called annual renewable term. The second way is you can buy term to 100. The difference is this, and what we're talking about, just to be clear, is we're talking about the cost of this wrapper, the cost of that $1 million. Okay, so one way you can do it is you can say, you know, I'd like to have a term to 100 cost. The advantage to a term to 100 cost is that it never changes. You will always know what it is from the day you buy it at age 35 until the day you maybe live till your age 100. It's always flat, it's always level. The disadvantage is it's extremely expensive. Insurance companies are making a bet on you living for a very, very long time, and so they will charge you a lot of money to have the privilege of never changing that dollar amount, that cost. You'll notice I'm not using the word premium. The reason I'm not using the word premium is because premium, as it pertains to these types of insurance policies, actually refers to all of the insurance and all of the investment combined. And because we're just talking about the insurance right now, we're going to deal with cost. So there's 2 ways to look at that. 1, I would like a cost that never changes, or 2, I would like a cost, an annual renewable term cost that does change over the years and somewhat exponentially increases. And this is a critical point here, is when does that one actually start costing me more than if I had just bought a level? Okay, so we're going to cover that just a little bit. If this here is, I'm going to use the number of $30 per month. If this is $30 per month, then this number here is probably about $150 per month. Okay, so just keep that in mind as we go through. We're going to show an example of this just in a moment, like an actual real example. But $30 per month versus $150 per month. Well, first of all, what if I can only afford $150 per month? I might decide at that point that, you know what, I would rather just, if I can only afford 150, I would like to have 120, at least at the beginning, going to the investment. This crossover year is probably somewhere in this client's early 70s, is usually when that becomes more expensive than $150 per month. By then, generally speaking, the insurance is probably less of a need and more of a luxury. So what we see fairly routinely is as people get into later years with these policies, they may reduce this, particularly if they have this type of cost. They may reduce this, but it still keeps the money in here tax sheltered, considered to be part of a death benefit if they pass away, so still able to pass tax-free to the next generation. So this may never happen, is what I'm saying. They may decide to tail that off in later years, and it might just flatten that line out as they get a little bit older, okay? So this generally is what most people opt for because they'd rather have more money going to an investment. Now, having said that, there's another line you got to pay attention to, and that line is the max line. And that is, how much does Revenue Canada allow me to take from my revenue and put into this thing every year and keep tax sheltered? There is obviously a limit. There's a huge tax advantage to these, so the government, of course, has to put some kind of a limit on that. So what's the maximum? And if I'm hitting this maximum line, if that's what I'm putting in, then these two calculations get a little bit more, I could kind of go either way. Maybe I'd like a level cost, or maybe I want this YRT, because of the difference in terms of the ratio of how much money is going to the investment gets to be bigger and bigger. So I'm going to use, for our purposes tonight, we're going to use a YRT or an ART, which is this increasing cost over time. And we're going to say that the client opts for the lower cost now, even though knowing that the cost is going to go up in later years. We'll address that in a little bit. All right. Now, what's the third or the other line? We already got the max line. There's another line here, and this line is the what I call the pension line. The pension line is how much, as a business owner, how much do you have to be putting in this thing every month and actually commit to it? Because obviously, if you're just putting in this, there's no point. You're just covering your insurance need. So there, you might as well have just bought a pure straight insurance instead of buying this type of a package. So you need to be at least willing to say, I'm going to put in this much money, and that much money might be $150 to $200 per month. It would be a fairly close assessment based on this being the cost. And this max line is probably going to be somewhere around $1,000 per month that I'm allowed to put in. Now, the reason we separate these two numbers is because, first of all, this has to be the number that a business owner says, you know what, that doesn't scare me at all. I can do the $200. I'm not concerned about it. I don't have any issues with committing to that for the long term. Please understand that as a business owner, flexibility is everything. So I didn't want to ever lock into something, even if it was only $200 a month, that I couldn't change, adjust, take a break from. This is an investment. It's up to you to decide how much you're putting in. But this is the number that we encourage people to start with, the number that they're very comfortable with. Knowing even if you can afford $1,000, let's make sure that we're not committing to that. So stick with this number, and worst case scenario, we can still take a break from that if we need to. I had a client call me today. Business is slow. I get that. That's in these times, that's not uncommon. And just said, what do I do if I can't do this? And I said, let's just shut it off for a while. Let's just shut this off, and this cost will be paid for out of the money you've already accumulated inside of here. They'll just pay it, and for this client, it was $61 per month. That's going to be coming out of their investments to pay their insurance. They don't have to keep contributing. That's just the fact of being in business. You're going to have some slow times. But then anything between this line and this line is fully accessible anytime. So what does that mean? It means for me that if I have more than I need in my operating account, more cushion than I need just to meet my next month's obligation, I am probably going to move that money into here. I call it free parking. That's where I park money that I might need again in a month or two or three. But, and again, everybody's different, and you need to decide for yourself if that's appropriate, if you're okay with that type of investing. But for me, I just dump it in there, leave it, and then my hope is I don't have to come back for it. My hope is that it's parked and I don't ever have to come back, but I know that I can go and get it if I need it or want it. The only reason I put it there is because I know I can come and get it. If I didn't think I could get it back, I wouldn't put it there because it would scare me. I'd feel like I'm leaving myself short. And I don't want to ever feel in business like I've been left short. So I'll park money here knowing I can get it. And I'll park money knowing because I know I can get it. And that encourages my behavior, which is a behavior of savings, which is critically important when it comes to shortening up these time frames of like retirement at age 70 versus retirement at age 55. All right. So those are some lines you got to be aware of. What's my cost? Obviously, that needs to be disclosed to you when you're working on these. What's the pension line? What's the number that's my anchor that I know that if I just keep putting that money in, I'm going to be okay when I get to retirement? This should be, you should be thinking about this if you're going to dividends. You should be thinking about this line, at the very least, making that your CPP line. How much was going towards CPP? I'm redirecting that, and I'm going to make that my pension line. It's probably a good place to start. And then the max line is, if I do really well in business, how much can I park in there? How much extra money can I shelter in there for the long term? So those are some of the lines you got to be aware of. Okay. How are we doing for time, Tammy? 7:20. 7:20, and what time are we wrapping up? 7:30. 7:30. Okay, I got a 7:30-ish. All right, so we're going to go back to our corporation now. 20 more minutes. Okay, we're going to go back to our corporation. I was going to demo exactly what that, the type of insurance that we just talked about. I was going to do a demo tonight on exactly what that looks like, how we build them, but apparently I'm too long-winded, so I'm going to skip that. But please understand, if you want more of that information, we are happy to show you that stuff, but we're not going to be able to get into that specific detail tonight. So we're going to take a step back again, and we're going to talk now about critical illness insurance. Now, critical illness insurance, let's talk about what it is first, and then I'll tell you why it plays into what we're talking about here tonight. Critical illness insurance is this: I pay a premium. If I get critically ill, cancer, stroke, heart attack, Parkinson's, different things like that, they pay me a lump sum, and that lump sum is whatever I've chosen to purchase in the first place. It might be $50,000, might be $500,000. Now, I'll be honest with you. I never bought critical illness insurance until I saw this strategy. Critical illness insurance was on my shelf to help clients with, but I never even sold critical illness and never bought it myself until I saw this strategy. Why? I think it's just two things. One, I hate always going back to clients and saying, hey, you should have another kind of insurance. That gets old. Secondly, personally, I hate paying for insurance. The only reason for me that I carry as much insurance as I do is I know I'm supposed to. That's you know, I guess that's not the only reason. I know I'm supposed to, but the second one is I know for me that it's sheltering my money and saving me way more in taxes than the actual insurance is costing me. It's cheaper for me to pay for life insurance than it is to pay passive income taxes on my investments inside my corp, or to take my money out of my corp, invest it personally, and pay personal taxes. So it's just a cheaper option for me, and the bonus is I get to carry a bunch of insurance. Critical illness is the same. I bought critical illness when I saw this strategy, and this is the strategy. And it's how we can deal with some more of the money that we've taken back into the corp, that we've uploaded back into the corporation. Critical illness, or I should say this is a product that's an innovative critical illness, and it's put up by Desjardins. Desjardins came up with this, I shouldn't say they came up with this idea. This idea has been around for a little while, but they've taken the idea and taken it to the next level in terms of it being above board, out of the gray, perfectly in the white. So this for us is important for our clients to make sure that they're not going to be offside from a tax perspective. So here's how critical illness insurance works in this setting. The corporation pays for the critical illness. Let's say that that's $200 per month. Me as the shareholder, I'm paying, currently I think I'm paying about $80 per month. But I'm not paying for critical illness. What I'm paying for is I'm paying for something called a return of premium rider. So personally, as the corporate owner, I'm putting in $80 a month. Why? So that after 15 years of paying this $280 per month, all $280 per month can be refunded back to me personally, tax-free, from the insurance company. So the insurance company basically collects my $280 per month, piles it up. If I get sick, then I get a check. The check comes to the corporation, so the corporation continues to function while I'm off getting better. But if I don't get sick, then at the 15th year or beyond, I can pull the trigger anytime I want and say, I would like all of my premiums back, but I want them to come to me tax-free. So I saw that as a way to evacuate $200 a month from my corporation tax-free without having to pay any taxes. And the CI, the critical illness, to me was just a bonus. Yeah, it happens now that I do have critical illness insurance, but it was a byproduct of a tax strategy for me. So I look at it this way. It'd be like if the bank approached me and said, look, if you open up a savings account with us for your corporation, you can pay your 10% tax inside the corp and then put your money into this savings account. And in 15 years, come back for it personally and draw it all out tax-free. I'd be all over that. Now, if they said, oh, and by the way, if you get sick in the meantime, we're going to pay you $100 grand. That'd be just like huge. That'd be a huge bonus for me. So that's how I choose to look at this. But you guys, I'm also a little bit weird. I hate paying for insurance. I play mental tricks on myself all the time, and I just pretend it's all an investment. Every month this $280 gets paid, to me, that's another investment. I'm not thinking about it as critical illness insurance. I'm thinking about it as investment. Every month I put money into my corporate sheltered tax life insurance policy. I see it all as investment. I don't look at what I paid for cost. I just pretend the whole thing's an investment. It's not mathematically true. I get that. I know the math, but that's the game I play up here. And the more money I can put into that, the less that insurance factor means anything to me. So that's the mental game that I play. One last thing I want to talk about when it comes to this stuff, and this is a pure insurance item, which for me is a little harder to pay for. But I want to show you again everything that I've done inside my own corporation and keep that above board, so I'm not leaving anything out. But I also pay for something called business overhead insurance. Business overhead insurance is it's like one of the advantages we have if we're incorporated is to be able to pay for business overhead insurance instead of disability insurance. Disability insurance is very expensive. Business overhead insurance is really a fraction of the cost for the same kind of payout. And so the advantage is I can pay a lot less money for business overhead insurance. And I'm talking like a lot less money for that. But the disadvantage is I have to have qualified expenses, because the business overhead insurance, if it pays out, does not pay me directly. It goes to the corporation to pay for expenses, i.e. rent. That's a good team. We got backup batteries. Okay, cool. So business overhead insurance, I don't know where I cut out there, but it's just cheaper. It covers all of my business overhead expenses, not me personally, versus disability, which would be paid to me personally, which is an advantage. The disadvantage is just significantly more expensive. Okay, so just to recap that real quick. Recap it real quick. Money flows in. I have a set dollar amount that I live on. I live below this line. I upload things that people normally pay for personally into my corporation. I take those uploads and I put them into two primary places. One is my life insurance policy, where I can shelter money. These life insurance policies, depending on what you pick for investments, can perform as good or better than mutual funds and so on outside of an insurance policy. And then secondly, I put some of it towards a critical illness policy. Both of these are tax strategies to long-term get money out of my corporation, either through death, sickness, or just spending at retirement in a tremendously tax-advantaged way. I'm just going to talk about this one just a little bit in terms of how we can draw that money out. We have two options for that, two primary options for that. There's lots of ways to do it, but the most obvious is the base level, pay your taxes and move on. And that is when I retire, if I've got money in here now, let's say that I've got $1 million of insurance, and I've managed to save $1 million in the investment. I can just begin to pay myself a dividend. During retirement, keeps my taxes reasonably low. My tax bracket during retirement is probably going to be a much lower tax bracket than you struggle with now. So I can minimize that, and I can take quite a bit of dividend without paying any taxes between my wife and I. But then anything I do get into a tax fix with, I'm going to pay about 15%. But probably by the time I draw this out, I'm probably not going to pay more than about 10% tax. If I don't want to deal with 10% tax, then I can go in a different direction. And that other direction, which again, we're not going to explain in detail tonight, but that other direction is to use this policy to go to the bank. This is not something that we tell people this is a guarantee it's going to happen. You have to be credit worthy. Banks still have to be doing these types of loans at the time. The government has to have not changed any legislation between now and then. So we want to caution you that this is something that people currently do, but it's not necessarily something that's going to be there in 30 years from now when you go to retire. So currently what happens is people take their policy to the bank and they assign it to the bank as collateral. What the bank then does is turns around and loans you about 6% of whatever this value is. So in this case, that would be about $60,000 per year. And they set it up so that income stream will come to you for life. You don't pay them back. You don't pay interest on the loan. It's called a capitalized loan. And the bank gets paid back when you pass away, because this money has never left. It's still inside the corporation, still inside the policy. And when it's still continuing to grow, so your insurance plus the investment both pay out, leaving plenty of money still for your family, and also enough to pay back the bank for the money that you spent during your lifetime. But because it's borrowed money, it's tax-free, so the government doesn't tax, at least for now, doesn't tax borrowed money. We'll see if that ever changes when we got to pay back $82 billion in money that they're paying out in COVID relief. Who knows where they're going to go for that kind of money. All right, let's just talk about COVID real quick. I recognize that we are now at our time threshold. It is 7:30. So if you've got to go, thanks for joining us. We really appreciate you being a part of it. I'm just going to say real quick right now, there is a link that'll be in the chat. It's the same link that you were sent in the email. So we'd really, really appreciate it if you go and hit on that link and give us a bit of feedback on what you thought of our material tonight. Did you learn anything tonight? That kind of stuff. Was the material appropriate for what you were looking for, etc.? We want to improve. As we do these webinars, we want to make sure that we're bringing value to people. So please go on those links, either right in the chat, which is being posted currently, or go back to the email that you were sent originally, and there'll be a link there. Click on that, go in, and there's a pre-fillable PDF that just gives us some feedback on how we did. There's also a part of that PDF where it says, I am interested in, or I'd like to know more about, and you can check some of those boxes. I want to be clear. If you put your name on that thing, or even if you don't put your name on that thing, but if you put your name on it and you don't say that you're interested in anything, we will not be calling you. If you check a box, we will give you a call. That tells us that you're interested in something and you'd like an answer on something. We will give you a call or an email or a text or something to connect with you down the road to see if there's questions we can answer. Don't check one of those boxes just to make us feel good. We feel fine. Check a box if you're serious and actually want to get some questions answered, and we'll go from there. Okay, so with that, I'm going to switch gears and just talk about COVID just a little bit. And I'm going to talk specifically, again, we like to try and give some value in terms of actual things you can do instead of just talking about sort of talking points about COVID. I think everybody on this call has probably already been told several times that this is a bad time to sell if you have investments. I think we all get that. And I'm happy to say that we really haven't had too many people calling the office and saying, I need to get out. Most of the people that have called the office have just been saying, you know, just give me some reassurance. I know it's a bad time to sell, but let's just talk it over a little bit. I need to be reassured. And so that is, of course, what we're here for. I tell my clients when they invest in the first place, I always say markets, I can guarantee you one thing, markets will go down. At some point, they're going to go down. Generally speaking, they go up more than they go down. But at some point, you're going to be calling me and stressed. And when you call me and you're stressed, my hope is that you're calling me because you have more money to put in. This is a wonderful time to be buying. Tongue in cheek, it's a whole lot better time to be buying than it was in January. And people were buying in January. So right now is a wonderful time to be buying. And so I want to encourage that behavior. Having said that, there's some practical things you can do as well. Let me give you one example of a practical thing that you can do. What if you're in the market right now, you can't really afford to lose more, you can't afford for your investment to drop at all, but you still want to be able to make some of that money back that it's currently down. And if I'm guessing you're somewhere in your investments, you're likely down somewhere between 10 or 15%, somewhere in that category if you're invested in the markets right now. If you're down more than that, by the way, we do have to talk. That sounds to me like you're probably in a fairly high risk environment. So somewhere in that 10 or 15%. What if you were able to put your money back into the market but right now you could take what you still have and you could get a 5-year guarantee of your principal. In other words, if you put $5,000 in, guaranteed in the 5th year, even if the market continued to slide right now and did not recover, you would still get your $5,000 back. So there's no risk to capital. You can put your $5,000 in, no risk to capital, you get your $5,000 out. But the upside potential is that that $5,000, it's not a crazy growth rate, but it could grow as high as $7,000 in that 5-year period. If you do the math on that, that's roughly just shy of a 7% rate of return. So your upside potential is I could make as much as close to 7% rate of return with zero risk on my capital. So there are investments like this that we'd be happy to help you with. These are investments that are not terribly common in the marketplace, but I think right now these types of investments are the kinds of things that people need to be thinking about if they want to recover their money but are tired of taking on the risk that they've been taking on in the past. Another type, for those that are nearing retirement or within even 10 plus years of retirement, if you have $100,000, and by the way, this number can be $1,000. It's not that that's the minimum investment. We do not do that. We don't do the, you got to have this much money to invest with us. We're very approachable when it comes to investments. So let's say it's $100,000 though. If you put it in, this one has another type of guarantee, but it's an income guarantee. How it works is you say, I'll put in $100,000 today, and when I retire, we will guarantee you X number of dollars in income. So let's say this is a 10-year period. This is going to be a little bit of rough math, but let's say it's a 10-year period you have before retirement. If you give us $100,000 today, we can guarantee you somewhere in the, and by the way, this is if you're 55 years old, 65 years old, and it doesn't have to be a hard number. You can retire with this type of a program anywhere from age 55 to age 75. But if you retired at 65, you would have 4, 16, 56, about just shy of $500 per month. So that would be your absolute guaranteed income. Now, this shouldn't shock anybody. This shouldn't be like, oh, wow, that's incredible. That's not the point. The point is, if you could put this in and know what your worst case income scenario is, much like a pension at work, that's pretty cool. But what if you could do that, and at the same time you could turn around and say, but I still want to invest this money. I still want to see if I can outdo the house, if you will. I want to see if I can do better than what you're offering me. And so then you get to go and invest it. And if you invest it and it does more, you get more. If you invest it and you lose, you do not lose this. You still have your minimum income guarantee. So that's another investment that we've seen a lot of money pour into over the last couple of years since we've been working here at Solomon. And it's something that for those clients that are currently in those investments, this market downturn is almost irrelevant to them. It's not fun because they still want to out earn it, but they know that they have this guarantee of income, and that's what the purpose of the money is in the first place. So if that's your purpose, if you're trying to drive income for retirement, I would suggest this is probably a good fit to look at some type of an investment like this. We'd love to chat with you about that. So again, if you would like to go on and give us a bit of feedback, we'd sure appreciate that. We work hard on these, and we'd sure like to offer better value if you can give us some suggestions. And if you like the material, tell us that too. That gives us a good pat on the back, and we appreciate it. You guys, want to thank you for being here tonight. We are just shy of 7:40, and we appreciate you spending the extra time with us. And we hope that as you go, you've gotten value. We hope that as you go, you stay safe, you stay healthy. And we want to thank you very much for your time. Have a great night.